Hey everyone, welcome. Today we're going to dive into a theory that, well, it pretty much flips everything you thought you knew about the markets right on its head. It argues the real power player isn't the Fed, but someone else entirely. So let's get right into it.
So let's kick things off with this quote because it really challenges how we think about, well, everything. It perfectly captures the spirit of things like Bitcoin, assets that live outside the old school systems of control. And that's the perfect mindset to have right now because we are about to question the biggest story in finance, the story of the all-powerful Federal Reserve.
Which brings us to the big question on everyone's mind, right? After so much uncertainty, so much doubt, have we finally turned a corner? Is this psychological shift in the market for real?
Well, it looks like the answer is a pretty clear yes. We're seeing this major shift away from that panicked feeling and towards, well, something a lot more like cautious optimism. Let's dig into the science, shall we?
Okay, look at this. It might seem small, but this shift is a huge deal. We've gone from extreme fear, which is basically panic mode, to just fear. Now, if you're a contrarian, this is a beautiful sight. A market that's still a bit worried, but not totally freaking out, that has a ton of room to climb that classic wall of worry. And look, this isn't just some vague feeling in the air. The technicals are backing this up, big time. You've got your high beta stocks, the riskier stuff, hitting new all-time highs. The Nasdaq just smashed through its downward trend. And this is the big one. It kind of blows up that whole argument about poor market breadth. It's not just a handful of giant companies anymore. The broader Russell 2000 is showing real strength.
And you know what? This good vibe isn't just locked up in the stock market. We're seeing the exact same kind of surge over in crypto, which a lot of people see as the ultimate risk-on bet. This tells us it's a broad, system-wide change in attitude.
Let's get even more granular. If you look at Bitcoin futures, you can see some serious conviction building. The ratio of aggressive market buys versus sells is at 1.17. That means buyers aren't just sitting around hoping for a dip. No, they're actively chasing prices higher, and that is a powerful sign of momentum.
Okay, so we've established the what. Sentiment is getting better. But now for the why. And this is where we get into the dominant market myth, the story that just about everyone seems to believe is driving all of this.
I'm sure you've heard this a million times, right? The story goes that the Federal Reserve is about to come riding in to save the day. The consensus belief is that they're going to open up the floodgates, pump in a ton of liquidity, and slash interest rates to get the markets roaring.
It sounds good, right? It's simple, it makes sense. But what if that's not the real story at all? What if we've been looking at the wrong character in this whole drama?
See, to really get what's happening, you have to look past the Fed. The key here is to realize there aren't just one, but two very different taps of money flowing into the economy. All right, this is probably the most important slide in this whole thing. When the Fed prints money, that liquidity mostly just bounces around the banking system. It boosts stocks and bonds. You can think of it as money for Wall Street. But when the U.S. Treasury spends money, it goes directly into the real economy. We're talking government programs, payments to citizens. That's money for Main Street. And its first most immediate effect, it pushes up inflation.
So think about it. If the Treasury is already pumping cash into Main Street and pushing prices up, what happens if the Fed also starts printing money like crazy and slashing rates? Well, you get a recipe for disaster, for runaway inflation. So the much more logical path for the Fed is to be careful. Maybe some moderate rate cuts, but just the bare minimum liquidity to keep the system from breaking.
And that right there brings us to the absolute core of this whole idea. The real engine here isn't a new flood of money from the Fed. Nope, it's a much more complicated and kind of brilliant balancing act being done by the U.S. Treasury. Okay, so here's how this crazy balancing act by the Treasury actually works. First, they spend money into the real economy, which, as we said, pushes prices up. But, and here's the genius part, at the exact same time, they sell Treasury bills to the market, which sucks the exact same amount of cash back out of the financial system. It's literally like they're pouring water into a bucket with their right hand while siphoning the same amount out with their left. So what's the end result of all this financial gymnastics? Well, the net effect on the total money available for the markets is zero. Nothing. It's a wash. The big takeaway here, the thing you really need to get, is that the main result isn't a bunch of new cash for Wall Street to play with. It's more inflationary pressure on Main Street. Okay, so if we accept this, if the markets aren't about to get a huge cash injection from the Fed, what on earth does that mean for the future? Let's take a look at the forecast based on this new reality. Well, let's start with hard assets, like Bitcoin. In an inflationary world, the cost to produce something becomes super important. And for Bitcoin, the estimated cost to mine just one coin by late 2025 is almost $75,000. That creates a really strong price floor because, why would a miner sell a Bitcoin for less than it cost them to create it? They wouldn't.
All right, now let's talk stocks. The forecast goes something like this. The rally we're in now, it can probably keep going through the rest of 2025, just based on that positive feeling we talked about. But as we get into 2026, those inflationary effects from the Treasury are going to get harder and harder to ignore. And without any new money coming in to push prices up, the rally is expected to run out of gas and just hit a ceiling.
And look, this isn't some wild theory from the fringes. The bond market, the so-called smart money, is already getting ready for this exact scenario. You're seeing traders shorting long-term bonds more and more, which is basically a direct bet that inflation is going to be higher for longer. They're seeing the same writing on the wall.
So all of this leaves us with one final and really important question for you. If the main event isn't a big liquidity party from the Fed, but this tricky balancing act from the Treasury, how does that change the way you see the market? What does that mean for your strategy as we head into 2026? It's a lot to think about. Thanks for digging into it with me.